Going into 2026, if you have a strategy and you feel like it works, but there's a missing piece that stops you from becoming profitable, or you just can't get over your psychological hurdles, this video is going to be for you. So in this video, I go over step by step how to actually read key levels. So imagine buyers step into the zone, you see buyers failing, and you know exactly when to sell. Now vice versa, when you see sellers coming into a zone and you see sellers failing, you know exactly where to buy. So in this video, I want you to take note, and I want you to go into 2026 trading with order flow, not anything else. For this video, I'm going to be going over an ES case study I took on the 9th of December. Now, this is continuing on with the footprint charts order flow series. I want traders to get super confident with using footprint charts with key levels. Now, I get a lot of questions about my key levels, and I'm going to keep hammering this in. So basically, there's 3 steps to any trading strategy, right? What you need is you need a key level, right? So let's label this in gray. This is a key level that you need. And when price comes into your key level, you are looking for an uptrend, either bullish, or you're looking for a break and retest to go bearish. Now, the way we do this, the way we want to understand this is you're looking for either what's going on here or what's going on here. So this is where footprint charts come into the picture. So we're going to be going over a buy trade today. So yesterday was a sell trade. Today is a buy trade, right? So what we look for in a buy trade, I'm going to be going over the opening range breakout, which is very important. How to use the opening range breakout with a key level, right? And more importantly, all these terms, fair value gaps, opening range breakouts, market structure shifts, even sweeps of liquidity, all these things are just amorphous terms, right? All these things are simply terms that confuse the picture, right? And the way we're going to unconfuse the picture, if that's a word, is by looking at order flow, right? So these are the 3 things we're going to look for. So you want to tag into a key level, you want to see buyers and sellers in the key level, and you want to use order flow to determine whether the key level is going to be a bullish key level or a bearish key level. So that's kind of how we're going to go about this video. So with this trade that I took, so my execution for this particular trade came, so just going to be going over this trade I took here. So about $542 for the day, S&P futures longs. So this was what the trade looked like in short, right? We had the first 5 minutes. We identified weakness in the first 5 minutes, right? 5 to 8 minutes, I think this was. So we're going to be going over the market open, 9:30, 9:30, 1, 2, 3, 4, and 5, right? So we break above the 5-minute range. Now, what's important to understand, when you break above a 5-minute range, it's not your job to just simply trade the orb, right? I'm not trading orb. I'm not trading fair value gaps. I'm not trading market structure shifts, right? These are redundant concepts. What I'm looking to do is I'm looking to plan my level and then trade off my level with order flow as a confirmation. The orb is not a confirmation, right? The orb is simply a pattern. Think of it as a redundant ICT concept. Now, just to give people some context on this, so what happened is price tagged into my key level. So if you trade ES, you should already know, I've made lots of videos on this, you should already know this was a key level from November. So 68.52 to about 68.42, 43. So about, let's just call it 68.50 to 68.45, 40 area. Now, this was a key level, and I get a lot of questions about how I find my key levels. And so for me to break this down, you need to understand order flow, right? So order flow is the most important aspect. So I'm just going to be breaking this down. So my ES game plan looks something like this. I was looking at 68.50 to about 68.40. So we want to be focusing on what's going on in this circled region as well as this circled region over here. Now, this is where the footprint charts come into play. Now, when we break this down, I want to just introduce traders to how footprint charts actually work. So the way footprint charts work is you have 2 numbers inside of a candle. So notice how I've done this deliberately. I've not zoomed in enough where any trader can read the numbers accurately. You don't need to read the numbers accurately. Your job is to read the delta. And the delta is the simplest thing you can identify, because the delta is simply the ask minus the bid, and you can see that color represented with either a red or a blue. So where I've circled here, this is a zoomed in ATAS footprint chart screenshot. Now, the reason I've showed you that is because we know at 68.40 to probably 68.35, 68.40 area, 68.35, 68.40, yep, there's aggressive sellers, right? the market is aggressively selling off, right? We see a lot of market participants entering, hitting the bid, looking to aggressively sell. Now, when you're looking at footprint charts, you're looking for who is aggressive at certain price areas, and you're looking for follow through, right? So let's take a look at this on the chart. So this corresponded to this region over here, okay? Now, the best thing I can do is get them side by side like I do. So what we saw over here was, this is TradingView on the left, and I'm going to get the ATAS platform on the right. So if you look at this ATAS platform, right, what we can see here, a huge amount of aggressive selling, but the market was unable to sustain lower prices. So we see a huge amount of aggressive selling, but the market breaks above our zone. So this was Monday, after the big sell-off we had on Monday. So what this shows us is that in this region, aggressive sellers have failed. Right, this is the absorption right here. So this is the absorption. So if you're stuck on how to find key levels, you need to get used to reading the order flow before the market opens, and you need to have these levels on your charts before 9:30 Eastern. Now the same thing happens over here. We're validating our level. So not here, this is market open. We're looking at this region here, right? This long wick. Now a lot of people, they see a wick and they see, oh, this is a sweep, or this is a rejection wick, whatever you want to call it. There's lots of amorphous terms that traders use. But the reality is, if you want to see who is in control of the market, you need to revert to order flow. And so that is what this second image is over here. So this long wick has been dissected. So let's break this down. So this long wick here on TradingView, the same 15-minute long wick here. When we break it down, what I've done in this screenshot is it's a zoomed in screenshot of the order flow on the ATAS platform. It's a zoomed in screenshot of the order flow of this wick, specifically inside of this key level. Now, I believe this is a 5-minute chart, but it's showing the same information. Now, what we can see here is two things I'm going to be going over. The first is, obviously, we can see massive red delta, massive negative delta, which signifies the fact that sellers are aggressive. Now, when sellers are aggressive, right, but the market really could not break below this zone. In fact, we saw that even at market open over here. So this is one thing I was looking for at market open, right? So this was obviously the trade I took. But before we go over the trade, right, this was sort of 9:29, 9:30. So if we take a look at the first 5 minutes, right? So if you're an orb trader, this is going to be for you. So we've gone too far. Let's go here. So this is the first 5 minutes. So 9:30, 9:31, 2, 3, there you go. So this is the first 5 minutes we're looking at. So you want to see what was going on here. So all these aggressive sellers, right? These aggressive sellers, again, this is the key level of 68.52 to about 68.40, 68.45 area. Now, these aggressive sellers failed to break below this level, right? We actually broke above this level here. Boom, boom, and even at market open here. So what's going on here? Before the market even opened, let's just go back here. This is the market open over here. This is that 5-minute opening range breakout. Now, these aggressive sellers failed, which means that there is a passive buyer over here, right? This is 10:39 UK time, so about 5 London session. So this zone held in the London session. So when we come back into this zone for market open, there's two things that can happen, and this is how simple you want to keep your trading. Either we break below the zone and we use order flow to confirm a retest to go lower, or we break above the zone like we did, and then we use order flow to confirm a move higher. That's all we need to do. Now, the reason using a pre-market plan with key levels is so powerful is because once you know where your key levels are, and once you understand what's going on inside of your key levels, all your fair value gaps, your inverse fair value gaps, your EMA crossovers, your RSIs, your MACDs, your opening range breakouts, your breaks of structure, your trend lines, no matter what you're using from an intraday or a swing trading perspective, no matter what your strategy is, if you know where your levels are, or you think you know where your levels are, you can start to look at the order flow and confirm whether buyers or sellers are actually sitting there. So before I came into this session, I knew that there was a large passive buyer sitting over there. Now, once again, the reason I knew that is because of here, right? I saw all these aggressive sellers failing to break below the zone, which shows me that passive buyers are in control. In this region here, there were passive buyers. Now we go to the execution. So the execution is probably the easiest thing in my opinion. We're just waiting for market open. So that's obviously 9:30. I have a rule, I don't trade the first 5 minutes. So my execution today was at around, so executions came at 68.56. 68.56, right? So let's put that in here. 68.56. There you go. Stops below here. Bit of a wide stop. I prefer keeping a wide stop during this market open because we've been a little bit choppy. And I targeted just over a 1-to-1 risk reward, 1.2 risk reward, I think it was, whatever it was. So risking about 350 to make about, yeah, it was about a 1.5R or something like that. So that was obviously my execution. But beyond the execution, which was here, so this is your classic 5-minute opening range breakout. The reason why traders fail at an opening range breakout is because they try to time it with market structure shifts and fair value gaps instead of understanding what makes an opening range breakout in the first place. Why does the market break out in the first place? What is it that makes a breakout actually happen? So that's what I hope to dissect here in this video. So candle by candle, because I get a lot of questions on this, so I break this down. So this is where it comes back to the XXX model. So the XXX, right, for those who don't know, I speak about this almost every day. So the XXX model is you need to know where to trade from, you need to know what to look for, and you need to know why you're looking for it. So these three things are very important. Where, what, why. So the first thing, right, the first thing is where. Where do you want to trade from? We've got our key level. The second thing now is the order flow. And this is where I'm going to turn to the order flow footprint charts, right? So this is the ATAS platform. This is MES on the 1-minute chart. Now, when you're looking at the market open, we're just going to be dissecting it candle by candle. Now, specifically, this is 9:30 Eastern. The first 5 minutes, or especially the first 1 minute, I'm not looking to see too much, to be fair. I just want to see how the market opens. So this is what we had over here. So we had 9:30 Eastern. Over here, market opens. So if we just do that. So 9:30, 9:31, 9:32, 9:33, 9:34. And this is where I started to eye up along, right? And then 9:35. Now, what has happened here in the first 5 minutes, or the first 2 to 3 minutes, right? So I'm interested now in 9:31, 9:32, 9:33, and then of course 9:34.5 where we break out. But when we see price breaking above the zone, we're looking at a retest. Now, when you look at a retest, every trader talks about a break and retest, but few traders quantify accurately what a break and retest actually means, right? There are few traders who can actually visualize what a breakout should be and why certain key levels hold the way they do. Now here, what we can see, this is now the candle at 9:31. This is this candle here, right? So we see a body. But what's interesting here is we see a lot of aggressive sellers. Now, specifically, we're looking at, let's just say 233 for 126, 90 for 62, 59 for 0. We see 5 for 0, 63 for 15. So if you look at these two candles, we see a lot of heavy aggressive selling. Now, when you see this heavy aggressive selling, so this is between, let's call it 950, let's call it 68.50 to 68.47.48, right? These 2 points here, we had a ton of aggressive selling, right? A ton of aggressive selling means that the market has an inkling. Get my words out. When you see a lot of aggressive selling in this region, the whole point of these aggressive sellers is to see a move to the downside. So what we saw was aggressive sellers and a lack of follow through, and this is the finishing sort of picture here. So we're looking for a key level, and after price tags into a key level, we want to focus on who is aggressive and who is responsible for follow through, right? So in this case, the follow through technically came through the buyers, right? Because we broke above the level, we had our retest, and then we broke above the level again, which is why my entry was at 68.56, right? Now, when you take an entry, the reason I went long was not because we broke above the zone, right? I felt confident putting my stop loss here. I did not take the trade. I did not take this bullish trade because the market broke above the zone. I did not take it because of a 5-minute opening range breakout. I took it because of the price action, even though it was a bit choppy. I took it because the price action was in my favor. Now, what do I mean by price action in my favor? I'm not talking about inverse fair value gaps or market structure shifts or any of these things. I'm not talking about SMT. I'm talking about what's going on in this region. So even if you were to stay in this chop, it wasn't the best price action, but if you just take a look at what was going on in this region, right, specifically here, let's break this down as well. So even from a order flow perspective, this was now this big down candle, this was now 940, and then we actually had, so first we had 937, right? So go to 937. So what was interesting here, you can't see this on a candlestick chart, but on a footprint chart, you can see a green candle. So a green candle means, you know, by definition, the price in that 1 minute range, in that 1 minute time span, the price is closed higher than it's opened. So we can see, of course, higher prices just by the nature of the candle, but we see a huge amount of aggressive selling. In fact, we see a negative delta, huge amounts of negative delta, right? 335 for 83, 82 for 9. That to us shows us that there is a lot of aggressive sellers, but the market is unable to break below the zone, right? So that shows us that the zone is a strong zone that supports buyers, right? Because aggressive sellers have failed. And that is the reason why an orb works. So if you have some opening range breakouts that work and some opening range breakouts that don't work, the reason for that is simply because there is no context behind the movement. And when you don't have context behind the movement, that is what causes problems. So we're just going to, again, if we just take a look at this candle at 40, this was a very good example of absorption, right? So this big red candle, huge amounts of aggressive selling, but we were unable to even get back to the zone, right? We had zeros, finished auctions. We had a lot of finished auctions, right? Which means that the volume by definition would be decreasing. And then, of course, we found support and continued to the upside. So the price action itself wasn't amazing. So if you held on to this trade, it would have been a painful hold, I think, you know, but eventually we did go on to hit our target. So this is a quick overview as to how you can use the opening range breakout with order flow, right? So again, footprint charts, are making a whole series on footprint charts. So again, if you have any questions, feel free to drop them in the comments.